This is part 3 on the Introduction to Financial Statements video series. In the first 2 parts, we discuss the types or forms of a business, who looks at the financial information of a business and why, and the major categories of activities of a business. This part is going to discuss how the accounting equation is impacted by those activities and how the financial statements use the accounting equation. And finally, some additional financial information that is present. There are 4 financial statements. They are the income statement, retained earnings statement, balance sheet, and statement of cash flows. Preparing the financial statements are what some people love about accounting. If it's done correctly, things balance at the end and the statements work together. They could still balance with a mistake, but most mistakes take things out of balance. And there are 4 statements, so it's important to note the formal things needed to set each up correctly. And it's very important to know how to show the date, because it's not all the same. We'll start with some basics before we go over the statements. When you're preparing an income statement, you're going to start by categorizing all the information. As mentioned several times, and you're going to be sick of me saying it, the terminology is important. I find it easiest to put things in categories before moving on. So it is easier if we label each item as an asset, liability, equity, revenue, or expense. We mentioned equity before, and it will be more clear in a moment, but for now, equity is common stock, dividends, and retained earnings. Since stock is the ownership, retained earnings are the earnings retained in the business after giving dividends, which is the owner's share of prior earnings. So after categorizing the items and knowing which items go on which statement, and which items carry from one statement to the next, we will prepare the statements. It's easiest to start with the income statement because the net income or loss goes to the statement of owner's equity. This statement can also be called statement of retained earnings, depending on how many equity items exist for the company. We'll call it a statement of retained earnings here. The ending balance of retained earnings is carried to the balance sheet, and the cash balance on the balance sheet is carried to the statement of cash flows. So it's very important to know which categories go on which statement. Each statement is important. The income statement is usually prepared first. It is important because past net income provides information for predicting future earnings. Also, note that some companies have such large income that the numbers may be shown in thousands or millions. An income statement is also known as the profit or loss statement, or the statement of revenues and expense. The income statement primarily focuses on the company's revenue and expenses during a particular period. Note the date is for the year, but it can also be for the month, quarter, etc. It is what happened over a period of time. It shows the revenue first, followed by the expenses. The difference, if revenue is greater than the expenses, is net income. If not, it would be a net loss. Either way, note that net income is double underlined. The purpose of the income statement is to show how the difference between the revenue and expenses, so we use a double underline for that amount. The revenue is what was earned during the year, and the expenses are the cost of doing that business. But if you look at the expenses, you might think supplies are an asset. But I mentioned using supplies was an expense, and it's using supplies. Most companies buy supply in bulk and keep them on hand. When they buy them, they maintain a supply inventory of sorts and have an asset. As the asset is used for the company's business, it's an operating expense. And this is one of those examples we will return to in later chapters, so I suggest you pay attention to the wording around the problem. To make the income statement, start with the heading, the company name, and yes, you state the name of the statement. There are many users who do not know what they're looking at, so it's helpful to tell them. Then note the date and the time period being covered. Then you start with revenues. This company only has one revenue item, but some have more. Next, list your expenses and give a subtotal. This can also be done in columns to make it easier for the reader. Show the difference, which in this case is net income. Don't forget the accounting double underline. After we know the net income or net loss, we need to know how much will be retained in the company. Since we start with one date and end with another, the time period is the same as the income statement. and this one states it for the month. Retained earnings increase due to net income, but it also decreases due to dividends paid to owners. So please remember that dividends are not an expense. They're a payment of prior earnings, so they're on this statement and not on the income statement. When making this statement, you start with the same title format as the income statement, and the time period is the same. It covers a period. Next, you add the beginning balance of retained earnings. That's the amount you were given. As long as you see revenue and expenses, you know the retained earning balance is as of the beginning of the period. Eventually, we'll close the revenue and expense account into retained earnings. We close them for this year so we can start next year with zero revenue and expenses. So, if there is a balance, the amount in retained earnings is the beginning balance. Next, then you add net income. You can use a subtotal. It's nicer since you're adding here and subtracting later. Then you subtract the dividends that are paid to the owners. I keep saying we're giving them a portion of the prior earnings, and this shows the money comes from what was earned in the past year or in prior years. Finally, you end up with a balance at the end of the period. Since the retained earnings statement's purpose is to show retained earnings, it is double underlined. Before we get to the balance sheet, I need to remind everyone of the accounting equation. It's the backbone of all of accounting. The total assets equals the total of liabilities and owner's equity. Things can happen on one side of the equation or both sides, but at the end of the transaction, the equation will always hold true. The balance sheet is the representative of the accounting equation. It shows the total assets equals the total of liabilities plus owner's equity. The heading of the balance sheet must identify the company, the statement, and the date. It is not like the other statements which cover a period. Since the amount of cash changes daily, this statement is based on the assets, liabilities, and owner's equity as of the last date of the period, and that's why we list just a date. Remember, this statement also contains what we call the accounting equation, assets equals liabilities plus stockholders' equity. You list assets first. We list them in the order of liquidity or how quickly they become cash. Liabilities and stockholders' equity follow. They can be below the assets or to the right of the list of total assets. Finally, you double underline the total assets and the total of liabilities and stockholders' equity. The purpose of the balance sheet is to show the balance in the accounting equation, so double underlining shows its purpose. Now for the statement of cash flows. It shows how cash was received and used during the year, so the date reflects the time period. And notice how the activities of operating, investing, and financing are used. This statement shows where cash came from and how it was used. If the difference between cash in and cash out was more cash in, the difference is cash flows provided. If there's more cash out than cash in, it becomes cash flows used. Notice also the beginning and ending cash balances are shown. The ending cash balance will be the amount that's in the balance sheet at the end of the year. So notice how the statements tie together. The net income is carried from the income statement to the retained earnings statement. The ending balance in the retained earnings statement is carried to the balance sheet. And the cash from the cash flow statement is the same as on the balance sheet. Now that we've covered the financial statements, you're aware that some information can't be explained thoroughly with numbers shown. So there are several places where other information is disseminated. In another video, we discussed who uses the financial information, so you shouldn't be surprised to find creditors require them. Also, U.S. companies that are publicly traded must provide annual report to shareholders. That annual report must show the financial statements we just discussed, the notes to the financial statements where the policies and other information needed is provided, management's discussion and analysis, or MD&A. This is management's opinion and their spin as well. There's an auditor's report, and that's also provided. An auditor is an outside accountant who gives an opinion on the financial statements being reported in accordance with the standards, GAAP. The auditor does not give an opinion on the company. If the financial statements are in accordance with the standards, there's enough information for users to develop their own conclusions. The audit opinion has to be what's called an unqualified opinion. And the only thing I want to say about the audit report is that an unqualified report is a good thing. A lot of times people just forget their terms. Unqualified does not mean something is subpar or not qualified. It means there are no qualifications. So you may have heard someone say, let me qualify my remark, or that information is valid if you're talking about small companies. Those are qualifications of the information. An unqualified report means the financial statements and notes follow GAAP. Nothing else needs to be added, and no qualifying statements need to be made. As a CPA, I also want to point out that this report is based on an audit and that this report may only be done by CPAs. So this video covers the accounting equation and how it's used in the balance sheet. It also covers the other financial statements and how they interrelate, as well as other information contained in the annual report. If you need additional information, check out the other videos or ask me a question.